Toyota Motor Corporation, traded in the United States under the ticker TM, is one of the world's largest automobile manufacturers and a global leader in hybrid vehicles. The 2026 to 2027 investment story is centered on Toyota's enormous scale, strong brand, hybrid leadership, financial strength, and shareholder returns, while the company simultaneously faces tariffs, EV competition, Chinese automakers, and margin pressure. The key question is whether Toyota can use its scale and financial resources to restore profitability while successfully navigating the global transition toward electrification. Toyota is headquartered in Japan, while TM represents Toyota's American depository shares listed on the New York Stock Exchange. Toyota's fiscal year ends on March 31st, meaning FY 2027 refers to the fiscal year ending March 31st, 2027. The company operates across passenger vehicles, commercial vehicles, hybrids, plug-in hybrids, battery electric vehicles, financial services, and mobility technologies. U.S. investors should also consider Japanese yen exposure and currency fluctuations. Toyota is primarily a scale, resilience, and shareholder return story rather than a high-growth technology stock. The company does not need 20% annual revenue growth to generate attractive returns. If Toyota maintains vehicle volumes, protects its hybrid leadership, improves margins, expands its EV portfolio, and continues returning excess capital to shareholders, earnings can grow even with modest revenue growth. The most important part of the thesis is therefore margin recovery. Toyota generated approximately 50.7 trillion yen of revenue in FY 2026, with operating income of approximately 3.77 trillion yen and net income attributable to Toyota shareholders of approximately 3.85 trillion yen. Operating margin declined to around 7.4%, compared with approximately 10% in FY 2025 and 11.9% in FY 2024. Toyota remains highly profitable, but the decline shows that tariffs, investments, costs, and other pressures have reduced profitability from its previous peak. Toyota's latest FY 2027 outlook calls for approximately 54 trillion yen of revenue, 3.4 trillion yen of operating income, and 3.25 trillion yen of net income. One of the largest challenges is U.S. tariffs, which management has estimated could have an operating income impact of roughly 1.4 trillion yen. Toyota has partially offset these pressures through higher volumes, pricing adjustments, productivity improvements, and cost management. How successfully the company manages tariffs will be one of the biggest drivers of 2026 to 2027 earnings. Toyota is not expected to deliver technology company-style growth. Its advantage is the enormous size of its existing revenue base. Even modest growth on more than 50 trillion yen of annual revenue can generate substantial additional sales and earnings. My base case assumes moderate revenue growth, stable hybrid demand, relatively strong pricing, and gradual improvement in profitability. If margins recover and vehicle demand remains healthy, operating income could eventually move back toward or above 4 trillion yen. Toyota's hybrid technology remains one of its greatest competitive advantages. The company invested in hybrids long before many competitors, creating significant engineering expertise, manufacturing scale, and consumer recognition. Hybrids provide better fuel efficiency without requiring customers to depend entirely on charging infrastructure. This makes Toyota particularly well-positioned in markets where EV adoption is developing more slowly. Hybrid leadership could therefore remain an important earnings driver during the transition toward full electrification. Toyota cannot rely on hybrids forever. Battery electric vehicles are becoming increasingly important, while Chinese companies such as BYD are competing aggressively on price, batteries, software, and vehicle technology. Toyota has the financial resources to invest heavily in EVs, but it needs to demonstrate that its new EV products can compete effectively. China is particularly important because Toyota could lose market share if local manufacturers continue moving faster in EV development. North America remains one of Toyota's most important markets, particularly across SUVs, pickups, crossovers, and hybrids. Toyota's reputation for reliability provides significant customer loyalty. The company has also demonstrated pricing power through price increases and product improvements. However, higher prices cannot continue indefinitely if vehicle inventories rise or consumers become more price sensitive. Local production, supply chain optimization, and pricing strategy will therefore be critical to future margins. Cost reduction could become one of Toyota's biggest earnings catalysts. Productivity improvements, fixed cost reductions, and manufacturing efficiency can increase operating income even without dramatic revenue growth. Toyota's enormous financial resources also allow it to continue investing in factories, batteries, R&D, and new technologies during difficult industry conditions. This financial strength gives Toyota an advantage over smaller manufacturers during the expensive transition toward electrification. Capital allocation is becoming an increasingly important part of the Toyota thesis. The company has been returning capital through dividends and share repurchases while continuing to invest in future technologies. Toyota has also announced a new 1 trillion yen share repurchase program, equivalent to roughly 4.2% of outstanding shares based on the company's stated figures. If shares are repurchased below intrinsic value, remaining shareholders can benefit from increased ownership of the company. Toyota's dividend provides another potential source of shareholder returns. The company paid approximately 95 yen per Japanese share for FY 2026 and indicated approximately 100 yen for FY 2027. The dividend alone is not the main reason to own TM, but dividends combined with buybacks and potential stock price appreciation can create an attractive total return profile. Because TM is an ADR, U.S. investors should also consider currency fluctuations when evaluating dividend income. TM investors are exposed to both Toyota's business performance and exchange rates. Toyota reports primarily in Japanese yen, while U.S. investors measure their returns in dollars. Currency movements can therefore affect the dollar value of TM. Other major risks include prolonged U.S. tariffs, weaker global automobile demand, rising raw material costs, supply chain disruptions, recalls, regulatory changes, and continued margin pressure. At roughly the high $190s, I would describe TM as reasonably valued rather than deeply undervalued. Toyota does not need a technology company valuation multiple to generate attractive returns. If earnings stabilize and profitability recovers, even a modest valuation re-rating could create additional upside. The biggest valuation risk is that investors assign Toyota a permanently lower multiple because of EV disruption, Chinese competition, and concerns about the long-term economics of traditional automakers. Using a normalized free cash flow approach, moderate long-term growth, gradual margin recovery, and a discount rate in the high single-digit range, I estimate Toyota's intrinsic value at approximately $205 to $225 per TM ADR under a reasonable base case framework. This is not a precise prediction because the valuation changes significantly with assumptions for margins, exchange rates, capital expenditure, vehicle volumes, and terminal growth. Nevertheless, the model suggests TM around the high $190s is not excessively expensive if profitability normalizes. My 2027 valuation framework is approximately $160 to $175 for the bear case, $185 to $200 for the conservative case, $220 to $225 for the base case, and $245 to $260 for the bull case. My primary target is $225. From a stock price around $197, that represents approximately 14% capital appreciation before dividends. For a mature global automobile manufacturer, that can represent an attractive risk-adjusted return if earnings remain resilient. In the bull case, Toyota successfully reduces tariff pressure, improves operating margins, maintains strong hybrid demand, strengthens its BEV competitiveness, and continues aggressive shareholder returns. Under those conditions, TM could reasonably reach approximately $245 to $260 during 2027. The upper end would require investors to become more confident that Toyota's earnings have bottomed and operating income can sustainably move above the current FY 2027 guidance. The bear case involves prolonged tariff pressure, weaker global automobile demand, accelerating Chinese competition, disappointing EV execution, and continued margin compression. If earnings expectations decline and investors assign Toyota a lower valuation multiple, TM could fall toward approximately $160 to $175. Toyota's strong balance sheet, brand, and shareholder return capacity could provide some downside support, but even high-quality companies can experience significant valuation declines when earnings expectations deteriorate. The biggest catalysts over the next 12 to 18 months are stronger than expected FY 2027 earnings, successful cost reductions, lower tariff pressure, continued hybrid demand, improved EV competitiveness, and additional shareholder returns. Investors should focus particularly on operating margin recovery. If Toyota can move margins back toward 8% or higher while maintaining strong hybrid demand and improving its EV position, the investment thesis would become significantly stronger. So, is Toyota TM a good stock for 2026, 2027? My conclusion is buy, accumulate with realistic expectations. Toyota is not a stock to buy expecting a quick 2x or 3x return. The opportunity comes from owning one of the world's strongest automobile companies while it navigates margin pressure and technological transformation. At around $197, I believe the risk-reward profile is reasonable. My base case target is $225, the bull case target is $245 to $260, and the bear case range is $160 to $175. The central question is whether Toyota can convert its scale, hybrid leadership, financial strength, and shareholder returns into sustainable earnings growth during the global transition toward electrification.